Most traders buy confidently near market tops, right when the composite man is quietly unloading his entire position onto them. Picture buying APL at its absolute peak, watching it collapse 40% while institutions walk away with your money. There's a moment just before the markdown, where the chart whispers the truth through narrow rallies, swelling volume, and feeble bounces. Learn to read those whispers, and you'll never again mistake a distribution zone for a buying opportunity. Every day, thousands of retail traders open their screens, see a surging stock, read a glowing headline, and rush to buy, convinced they have finally caught a winning move. They feel the momentum. They trust the volume. They believe the news. And in that very moment of peak confidence, they hand their money directly to the operator who engineered the entire spectacle for exactly this purpose. This is not misfortune. This is design. Study any major market top in modern times, whether it was a high-flying technology stock in 2021, a cryptocurrency surging on social media hype, or a meme stock exploding overnight, and you will find the same fingerprint beneath the excitement. Volume expands dramatically. Price spread widens. The financial media celebrates. Retail participation reaches a fever pitch. And yet, if you examine the price bars with discipline and remove emotion from your analysis, you will notice something deeply revealing. Price is advancing, yes, but it is advancing with increasing effort and decreasing ease. This is the preliminary supply phase. This is where the composite man, the collective force of institutional operators, hedge funds, and smart money, begins quietly transferring his inventory onto the public. Understand the mechanics clearly. A large operator cannot simply sell millions of shares at once. To do so would collapse the very price he is trying to exit at. He requires a willing, eager, and emotionally charged crowd of buyers to absorb his supply. So he allows price to rise. He permits the headlines to build. He lets the momentum traders pile in. And with every excited retail purchase, he is on the other side of that trade, selling. In today's markets, this process is visible in the data. A watch for stocks that gap up on earnings with enormous volume, yet close well off their highs. Watch for assets that make new all-time highs on heavy volume, but fail to sustain the advance by the close of the week. Watch for the rally that draws massive public attention on social platforms, while the price spread quietly narrows on subsequent sessions. These are the modern signatures of preliminary supply, the composite man at work in plain sight. Here lies your advantage. Once you understand that surging volume near a prolonged high is not confirmation of strength, but rather evidence of a transfer in progress, the entire picture changes. You are no longer the excited buyer chasing momentum. You become the calm observer reading the motive behind the action. The composite man depends on your ignorance. The moment you study his methods, you are no longer his prey. You become his student, and a student who understands when institutions are selling will never again confuse a market top for a buying opportunity. That single shift in perspective is worth more than any indicator, any algorithm, or any financial headline ever written. The tape always tells the truth, if you know how to read it. There is a moment in every major market top that feels absolutely undeniable. Price explodes upward with breathtaking force. Volume reaches historic levels. Every financial channel, every trading community, every social media feed is screaming the same message. This stock is unstoppable. Traders who hesitated for months finally surrender to the pressure and buy. They tell themselves they have been patient long enough. They believe this surge is the confirmation they were waiting for. It is not confirmation, it is a closing door. This is the buying climax, perhaps the single most dangerous moment in all of market analysis. Not because the price is falling, but because it is rising with such convincing ferocity that virtually no one suspects what is truly happening beneath the surface. The very force of that surge is what blinds the public to the institutional exit being executed against them in real time. Stop. Look at what is actually occurring. The buying climax is engineered, not accidental. The Composite Man requires maximum public participation to unload his enormous inventory without destroying the price he is selling at. He therefore allows, and in many cases orchestrates, a final, explosive price advance. In today's markets, this is frequently accompanied by a blowout earnings report, a major product announcement, a Federal Reserve decision, or a viral narrative on financial social platforms. The news is real. The enthusiasm is genuine, but the purpose it serves is institutional distribution at scale. Examine the modern evidence carefully. When Nvidia surged on AI euphoria in 2023, certain sessions showed enormous volume, with price closing well off intraday highs, a classic buying climax signature. When Bitcoin crossed psychological price levels on record retail exchange inflows, the same pattern emerged. The candle looked powerful, the volume looked bullish. But the spread told a different story: wide range on the way up, then a swift inability to hold those levels. That inability is the confession. In practical terms, a buying climax on your bar chart will show an unusually wide spread price bar closing near its high on the heaviest volumes seen in months, sometimes years. What follows is the critical tell: price cannot replicate that advance. Subsequent sessions produce narrower ranges, lower highs, and a gradual erosion of momentum. The engine that powered the surge has gone quiet because the Composite Man has finished his selling. There is no more institutional fuel to sustain the move. This understanding transforms how you approach every explosive rally you will ever encounter. Rather than asking, "How high will this go?" you begin asking, "Is this effort being rewarded with result?" When a stock surges on maximum volume but delivers diminishing upward progress over the following sessions, you are not watching a launch pad. You are watching a ceiling being built, brick by brick, bar by bar. The most expensive mistake in trading is buying the climax. The most profitable discipline is learning to recognize it. When the crowd is most certain, the Composite Man is most finished. After a powerful surge, price suddenly drops sharply, swiftly, and without obvious reason. The trader who just bought near the top stares at the screen in disbelief. The news is still positive. The fundamentals haven't changed. The analysts are still bullish. Yet the price is falling with an urgency that feels deeply wrong. Panic begins to creep in. Fingers hover over the sell button. The trader asks the question that has cost more fortunes than any other in market history. Should I hold, or have I made a terrible mistake? Most traders in this moment make one of two equally destructive decisions. They sell in panic at the worst possible price, locking in a loss. Or they hold with blind hope, watching the position deteriorate further while waiting for a recovery that increasingly feels uncertain. Both responses stem from the same root cause. They do not understand what this price behavior actually represents. This drop is not random. It has a name, a structure, and a deeply revealing purpose. What you are witnessing is the automatic reaction, the natural and inevitable consequence of institutional buying evaporating after the buying climax. When the Composite Man finishes distributing his inventory, the enormous demand that was artificially sustaining price simply disappears. With heavy supply still present and no institutional bid beneath the market, price falls quickly and mechanically. It is not driven by bad news. It is driven by the sudden absence of the only force that was holding it up. In modern markets, this pattern is strikingly consistent. A high-profile stock gaps up on earnings, surges through the session, then reverses violently over the following 2 to 3 days on no new negative catalyst. A cryptocurrency makes a new all-time high on a Sunday evening when retail volume peaks, then slides 15% through the week as institutional desks return. A heavily promoted IPO opens with explosive demand, then corrects sharply within days as the initial hype evaporates. In each case, the automatic reaction is simply gravity reasserting itself after artificial elevation. But the automatic reaction alone is not your confirmation. The truly critical evidence arrives in what follows, the secondary test. After price drops to establish a lower boundary, it will attempt to rally back toward the level of the buying climax. This rally is the market's second examination of that supply zone. And here is where you must observe with absolute precision. Volume should contract meaningfully and price spread should narrow noticeably compared to the original surge. The market is attempting to reclaim its highs and failing quietly. That quiet failure is the most important signal a distribution trading range can produce. In practical application, when you see a sharp post-climax drop followed by a weak, low-volume rally that stalls beneath the prior high, you are no longer guessing about market direction. The structure is speaking clearly. Supply is dominant. The ceiling has been confirmed. The trading range that will ultimately resolve downward has officially begun its construction. 2 price swings, 1 sharp drop, 1 feeble recovery. Most traders see confusion in these movements. A trained Wyckoff analyst sees architecture, the precise framework of a market top being built in plain sight. You no longer need to guess when you understand what the structure is telling you. The chart is not hiding the truth. It is displaying it for those disciplined enough to read it without emotion. Price never lies. Only our interpretation of it does. The stock has pulled back twice. Each time, optimistic traders stepped in, reassured themselves it was merely a healthy correction, and bought the dip with confidence. The price recovered partially, enough to restore hope, enough to quiet the doubt. The trading range looked constructive. The pattern seemed familiar. Everything pointed toward one more push higher. Then price broke lower aggressively, decisively, and on volume that left no room for comfortable interpretation. The dip buyers are now trapped. The bulls are silenced. And the traders sitting in a long position feel something far worse than a loss on paper. They feel the ground shifting beneath them, and they do not yet understand why. At this precise moment, most traders reach for explanations outside the chart. They scan for news. They check earnings calendars. They search social media for someone to tell them the selling is temporary, that the fundamentals remain intact. That patience will be rewarded. They look everywhere for answers, except the one place that has been broadcasting the truth all along. The chart already told you. Several sessions ago. In a language most traders have never been taught to read. What you are witnessing is the sign of weakness, one of the most structurally significant events within a Wyckoff distribution trading range. It is a down move that reaches toward or slightly beyond the lower boundary of the trading range, occurring on noticeably increased price spread and meaningfully elevated volume. It is not a routine pullback. It is not a shakeout designed to accumulate more shares. It is a change of character, a fundamental, measurable shift in the balance between supply and demand, recorded permanently on the bar chart for any disciplined analyst to observe. The sign of weakness does not arrive without warning. It is preceded by the automatic reaction and the failed secondary test discussed previously. Together, these events form a sequential narrative that the composite man writes across your chart over days, weeks, and sometimes months. In today's markets, this sequence appears with remarkable regularity. When the S&P 500 broke its 2022 trading range on expanding volume after multiple failed recovery rallies, that was a sign of weakness at the index level. When high-growth technology stocks in 2022 violated their consolidation lows on massive institutional selling volume after months of distribution, each breakdown was a sign of weakness executing precisely as Wyckoff described over a century ago. The instruments change. The human behavior driving them does not. What makes the sign of weakness uniquely powerful as an analytical tool is what it measures beyond price. It measures commitment. When price falls sharply on high volume, large operators are not reducing positions cautiously. They are actively driving price lower to establish short positions, to trigger stop losses beneath support and to accelerate the markdown that has already been decided. The volume is not incidental, it is intentional. And its presence on a down move, contrasted against the shrinking volume seen on prior rallies within the trading range, tells you with striking clarity who now controls this market. Once you can identify the sign of weakness with trained eyes, a profound shift occurs in how you engage with every distribution structure you encounter. The breakdown that once triggered panic now triggers preparation. The aggressive selling that once paralyzed your judgment now provides you with an entry signal, a directional bias, and a framework for managing the trade that follows. The market has not turned against you. It has simply revealed its hand to those patient and disciplined enough to have been watching the entire sequence from the beginning. Supply does not hide. It announces itself in volume, in spread, and in the undeniable character of the move. After weeks of painful consolidation, the moment every waiting bull has been praying for finally arrives. Price breaks decisively above resistance. The level that had rejected every prior rally attempt is shattered with authority. Volume surges. Breakout alerts trigger across every trading platform simultaneously. The traders who sold too early feel regret. The bears scramble to cover their short positions. And the crowd, the vast, eager, emotionally exhausted crowd, rushes back in with renewed conviction, certain that the uptrend has finally resumed. Within days, sometimes within hours, price reverses. The breakout fails. Every buyer above resistance is immediately underwater. The move that felt like liberation becomes a prison. The more experienced traders dismiss this as a false breakout, an unfortunate but random occurrence, a product of bad timing or bad luck. They adjust their stops and wait for the next opportunity. But what they fail to recognize in that moment of frustration is that this was not a random failure. It was a calculated, precisely engineered maneuver executed by the composite man with a singular purpose: to extract the last remaining dollars from the public before the markdown begins in full force. This is the upthrust after distribution, the UTAD, and it is among the most sophisticated weapons in the institutional operator's arsenal. To understand why the UTAD works with such ruthless consistency, you must understand what the composite man requires at this late stage of distribution. By the time the UTAD occurs, he has already sold the majority of his inventory during the buying climax and the subsequent trading range. But there remains one final problem: the short sellers. Traders who correctly identified the distribution structure have positioned themselves for the coming decline. Before the composite man can drive price aggressively lower, he must first remove this competition by triggering their stop losses above resistance. So he pushes price above the trading range boundary, just enough to trigger breakout buyers and force short covering simultaneously. This creates a brief but intense surge that appears entirely genuine to the untrained eye. In modern markets, this pattern has appeared with striking regularity. In 2021, numerous high-cap technology stocks staged powerful breakouts to new all-time highs on heavy volume, only to reverse catastrophically within 2 to 3 weeks, trapping an entire generation of momentum traders at the absolute peak. Bitcoin's move above the 68,000 in November 2021, celebrated universally as the beginning of a new leg higher, was followed by a devastating 75% decline. The UTAD did not fail those traders through bad luck. It succeeded against them through their own predictable behavior. The identifying characteristic of a genuine UTAD on your bar chart is the swift, decisive reversal back below the resistance level it appeared to break, occurring on contracting volume relative to the initial thrust. The effort was enormous. The result, when measured from the perspective of sustained price advance, was zero. That divergence between effort and result is the confession. Every false breakout you have ever experienced in your trading career deserves to be examined through this lens. How many times did you buy a breakout with complete conviction, only to watch it reverse immediately. How many of those moments were not failures of your timing, but successful executions of the Composite Man's final distribution campaign? When you learn to identify the UTAD within its full structural context following the PSY, BCAR, ST and CEDU, you will never again chase a breakout blindly. You will instead ask one precise question before committing a single dollar. Is this a genuine resumption? Or is this the last engineered move before the floor disappears? That question alone will protect more capital than any stop-loss ever written. The most dangerous move in any market is the one that looks most convincing, right before it fails completely. Price has been falling for several sessions. The decline has been sharp, uncomfortable, and relentless. Then, without any obvious catalyst, it pauses. A modest rally emerges, quiet, unhurried, almost reassuring in its gentleness. The trader who has been holding a long position through the entire decline exhales for the first time in days. The trader who missed the original entry sees what appears to be a second chance. Forums and trading communities begin whispering that the sell-off is over, that the worst has passed, that the stock is finding its footing. Both traders reach the same conclusion: this recovery is the beginning of something. They prepare to buy. They are about to make the most precisely timed mistake of the entire distribution sequence. This rally feels different from the violent swings that preceded it because it genuinely is different, not in the way these traders believe, but in a way that carries devastating implications for every buyer who participates in it. The very calmness of this advance, the very absence of urgency in its construction, is not a signal of stability returning. It is evidence of something far more troubling. That demand has been so thoroughly exhausted by the distribution process that not even the institutions that once supported this stock are present to generate meaningful upward pressure. The market is not recovering, it is gasping. This is the last point of supply, the LPSY, and it represents the final chapter of the distribution trading range before markdown begins without restraint. After a sign of weakness has carried price toward or through the lower boundary of the trading range, the LPSY forms as a feeble, low-conviction rally on demonstrably narrow price spread and visibly contracted volume. It is the market's final attempt to rally, and the attempt fails quietly, without drama, because there is simply nothing left to sustain it. The mechanics are precise and consistent across modern markets. When Meta Platforms collapsed through its 2022 distribution range, the brief stabilization rallies that appeared mid-decline were textbook LPSYs, narrow-bodied candles on shrinking volume, unable to reclaim even a fraction of the prior resistance levels. When speculative growth stocks violated their 2021 distribution bases, each successive bounce that failed to recover meaningful ground represented a new LPSY, each one confirming with greater certainty that the institutional bid had permanently withdrawn. In cryptocurrency markets, the repeated feeble recoveries following Bitcoin's break below 60,000 in late 2021 produced a sequence LPSYs that any trained Wyckoff analyst could identify and position against. Weeks before the broader public acknowledged the trend had changed. What distinguishes the LPSY from an ordinary pullback in a healthy uptrend is the precise combination of three observable characteristics. First, it occurs after a confirmed sign of weakness has already demonstrated supply dominance. Second, the rally itself produces narrowing spread and declining volume, effort diminishing, not building. Third, it fails to reach the midpoint of the prior trading range, let alone challenge its upper boundary. These three conditions together form one of the highest probability short entry signals that Wyckoff analysis produces: low risk, clearly defined, and structurally justified by everything that preceded it. This is the moment where months of patient observation converts directly into actionable precision. Every prior event in the distribution sequence, the buying climax, the automatic reaction, the secondary test, the sign of weakness, the UTAD, has been building toward this single, clarifying structure. The LPSY is not the beginning of your analysis. It is the conclusion of it. The trader who has followed the entire sequence arrives at the LPSY not with anxiety, but with calm certainty. The entry is defined. The stop placement is logical. The directional bias has been confirmed by every preceding event. What once appeared as a confusing tangle of price movements is now revealed as a coherent, readable story. One the composite man has been writing across your chart from the very beginning. When demand makes its last feeble attempt to recover, the disciplined analyst does not hope. He acts. The stock looks strong. Every rally is greeted with enthusiasm. The price chart shows a series of higher highs that appear constructive, even bullish. The moving averages are properly aligned. The technical indicators signal continuation. Every visual cue available to the conventional trader points in one direction, upward. Traders build positions with confidence. Analysts raise price targets. The thesis feels airtight, supported by both price structure and fundamental narrative. Then, without warning, the entire advance collapses. Not gradually, not with early signals visible to the naked eye, but swiftly, violently, and completely, as though the strength that appeared so convincing was never real at all. For the trader caught inside that collapse, the damage is not merely financial, it is psychological. Because the chart looked right, the analysis felt sound, and yet the outcome was catastrophic. There was a warning. There is always a warning. But it was not written in the language most traders have been taught to read. It was not visible in price alone. It was recorded precisely, consistently, and without deception in volume. And the tragedy is not that this warning was hidden. The tragedy is that it was ignored, because most traders have never been taught to treat volume as the primary language of institutional intention. Price is the story the market tells the public. Volume is the truth the market tells itself. This is the essence of Wyckoff's law of effort versus result, the most penetrating analytical tool available to any student of market behavior. It states, with elegant simplicity, that volume represents the effort expended in producing a price move, and that price represents the result of that effort. When effort and result are in harmony, when high volume produces substantial price advance, demand is genuine and the trend is trustworthy. But when effort and result diverge, when high volume produces only marginal price progress, the divergence is a confession. Something is absorbing that effort. Something large, something institutional. In modern markets, this divergence appears with remarkable frequency at major distribution tops. During Tesla's 2021 peak, several sessions produced the highest volume in months, while price advanced only marginally and closed well below intraday highs. Textbook effort without result, signaling that every wave of retail buying was being systematically absorbed by institutional selling. During the Nasdaq's 2021 distribution phase, rallies on declining volume and reactions on increasing volume created a persistent pattern of bearish effort, result divergence that preceded the 2022 collapse by months. In cryptocurrency markets, Ethereum's final rallies before its 2022 breakdown showed identical characteristics: enormous volume, shrinking candle bodies, and progressively diminishing upward progress per unit of effort expended. The practical application is straightforward once the principle is internalized. On every rally within a suspected distribution trading range, ask one question: is this volume producing proportional price advance? If 3 consecutive rallies each require greater volume to achieve lesser upward progress, supply is overwhelming demand regardless of what the price chart appears to suggest. Conversely, when reactions within the same range occur on expanding volume with wide downward spread, the institutional commitment to the downside is being revealed in real time, sessions before any conventional indicator confirms the change. This is the advantage that Wyckoff's methodology delivers that no price-based system alone can replicate. Price can be temporarily manipulated. Momentum indicators can be engineered to appear constructive during active distribution. But volume, the aggregate record of every share transacted at every price level, cannot be fabricated. It is the one unfiltered signal in a market otherwise saturated with misdirection. Every major market top you will ever encounter in your trading career will leave this same evidence behind. The volume will tell you before the price does. The divergence will appear before the breakdown. The effort-result imbalance will be recorded on your bar chart weeks before the crowd acknowledges what has happened. You do not need to predict the future to trade with precision. You only need to read the present with honesty, discipline, and the understanding that volume is not a secondary indicator to be consulted after price has already moved. It is the primary language of those who move markets, and it has been speaking the truth on every chart, in every market, across every era of trading history. The composite man cannot hide his intentions from volume. He can only hope you are not watching it closely enough to notice. For the majority of traders operating in today's markets, every major top will follow the same invisible script. They will buy the excitement of the preliminary supply phase, convinced that institutional volume confirms their bullish thesis. They will chase the buying climax, interpreting the most dangerous moment in the entire distribution sequence as the breakout they have been patiently waiting for. They will hold through the automatic reaction, reassure themselves during the feeble secondary test, and dismiss the sign of weakness as temporary noise. They will be trapped by the upthrust after distribution, the most perfectly engineered deception the composite man produces, and they will buy the last point of supply, believing the worst is finally over. They will repeat this sequence in different stocks, across different markets, across their entire trading careers, and never once understand why their analysis keeps failing at the same critical moment. The market does not fail these traders. Their education fails them. What you have studied across these 7 keynotes is not a collection of isolated patterns. It is a single, unified narrative, one that the composite man writes across every distribution trading range, in every freely traded market, with a consistency that transcends time, geography, and instrument. The preliminary supply, the buying climax, the automatic reaction, the secondary test, the sign of weakness, the upthrust after distribution, the last point of supply, these are not random events. They are sequential chapters of a story being written with institutional precision, powered by predictable human emotion, and concluded with a markdown that transfers wealth from the uninformed to the prepared. Volume is the thread that connects every chapter. It does not lie. It does not mislead. When effort produces diminishing result on rally after rally, when reactions carry greater volume than advances, when the spread contracts precisely as the public grows most confident, the tape is speaking. It spoke during the collapse of the Nasdaq in 2022. It spoke during Bitcoin's 75% decline from its 2021 peak. It spoke during the destruction of speculative growth stocks that an entire generation of retail traders had staked their financial futures upon. It was speaking the entire time. Most simply had not been given the language to hear it. You now have that language. This is the singular inheritance that Richard D. Wyckoff left to every serious student of market behavior. Not a system of mechanical rules to be followed blindly, but a disciplined framework for reading the motive behind every price movement, the intention behind every volume surge, and the architecture behind every trading range. A framework that transforms the overwhelming complexity of modern markets into a readable, actionable, and profoundly logical structure. The composite man has not changed in the century since Wyckoff first described him. He has merely found new instruments, New headlines, new technologies through which to execute the same campaign against the same predictable human emotions. The algorithm executing distribution across thousands of price levels in milliseconds today is governed by the same supply and demand mechanics that governed Jesse Livermore's campaigns in the early 20th century. The structure remains, the sequence remains, the volume signature remains. What changes, what must change is you. Study the trading range before you trade the breakout. Read the volume before you trust the price. Identify the phase before you commit the capital. And when the entire sequence aligns, when the buying climax has been confirmed, the secondary test has failed, the sign of weakness has spoken, and the last point of supply has formed its feeble, exhausted rally. Act with the calm precision of someone who has been reading the story from the very first page. The market will always reward preparation over reaction, knowledge over impulse, structure over emotion. Richard Wyckoff dedicated his life to a single mission: to teach the public the real rules of the game as played by those who control it. The game has not ended. It is being played on your screen, in your portfolio, and in your trading decisions at this very moment. The only question that remains is whether you are still playing it blind, or whether you have finally learned to see. The tape tells the truth to those disciplined enough to listen. It always has. It always will.